Hey everyone, this is Abhishek again from Ingenesis Consultants and Provit Private Limited. First of all, thank you for liking our previous videos and leaving your valuable comments. We are trying to incorporate your comments at the best way possible in our existing video as well, in our coming videos as well. Thank you for your support and thank you for liking our video blogs and our subscriptions. Uh, so carrying on from our previous videos of types of mutual funds, we will like to go further and try and bifurcate them further and explain you what all different types of mutual funds are there, and how does those bifurcations impact our investment decisions and impact our lives in general. So just to bifurcate, here is the bifurcation that I've done for you. These are the type of mutual funds. As explained in my previous video, we can bifurcate it into equity, balanced, hybrid, and debt. Main two categories are equity and debt, where equity are mainly stocks that we buy in the companies, high risk, high return, and debts are more into bonds and more into government of securities, low risk, low return. And balanced is mainly, balanced and hybrid are basically combinations of equity and debt in the percentages which I have mentioned. So balance can be about 60-65% equity and about 35 to 40% debt, whereas hybrid can be about 80-85% debt and 15 to 20% of equity. Those are the products that are available. Now, just to bifurcate, if we talk about equity first of all, so equity is bifurcated into these products. Now, large cap, mid cap, small cap, micro cap, and ELSS. Now, large caps are the blue chip companies of the world. So let's say an ICICI Bank for that matter, an SBI Bank, Tata's, Reliance's. So these are the large cap funds and large cap equity funds. Then we have a mid and small cap category where banks, if I take a banking sector example only, then probably an IndusInd Bank or a Yes Bank will fit into. Micro caps are really small companies, something like probably a Ratnakar or a Saraswat Bank, or even so that's an example. So how does these bifurcation impact us? So large caps are mainly blue chip companies, so the volatility in these funds is less, but at the same time the returns can also be less because these companies have already achieved a certain level, and to achieve further growth, their further growth will be capped. It won't be like going out of the box and going from a varied range, like probably a growth of 100 and 120%. You don't expect such a growth from large cap companies, right? Because they've already achieved a particular level. Hence the returns are a little lower, but at the same time the volatility is also lower because they are large caps, and because they are blue chips, the volatility is not there in the returns. If I talk about mid caps, what I'll do is I'll take mid caps, small caps, micro caps in the same category. Mid caps, small caps, micro caps are companies which are probably at a growing stage as of now. Some of the companies you wouldn't have heard of, some of the companies which are listed but you haven't heard of them. In such companies, because they are in a growing stage, what happens is the return scope increases. The rate of returns that you can expect out of these companies, the scope of that increases a lot as compared to large caps. But at the end of it, because they have, they are still at a growing stage, they are probably at a starting up stage or probably in a mid stage of their growth. What happens is the volatility is also a lot in these kind of funds. So for people who are looking for more of a stable return, and even if a lower return is fine with them, I think large cap funds are the ones for them. Whereas people who are looking for probably a higher return, short term volatility doesn't matter to them as long as they get a return in the long term, then mid cap, small cap, micro caps are the one for them. ELSs are equity linked saving schemes. These are part of equity funds only. The only advantage of ELSs is that it gives you a ATC benefit as well. So there is a 3-year lock-in in ELSs funds, and you get a 1.5 lakh of ELSs benefit. The ATC benefit out of them. So 1.5 lakhs is deducted from your taxable income, and so you save tax if you invest in these funds. That's the only difference in ELSs. Coming to debt. Now, debt funds can be further categorized as accrual, dynamic, and liquid funds. What does this mean? So accrual funds are mainly corporate bonds, right? You get an accrual interest on them without any fluctuations. Average right now being in September 2016, we're getting about 10.25% on these funds. On an average, we keep on getting about between 9.5 to about 10.75% on these funds. The main advantage of these accrual funds are they are not very sensitive to the interest rate cycles in the market. So if there is a repo rate cut or a repo rate increase in the market, they are not very sensitive to it. Exit loads are usually 1% for 1 year. In some funds, there is an exit load of 3 years as well. In income and dynamic funds, if I come to so that's the accrual part with an exit load. If I talk about liquid funds are the same as accrual funds, but only without an exit load. So an accrual fund, if they've taken a corporate bond for, let's say, 2021, in a liquid fund they would not take the papers more than 1 year. So that's the maximum that they take. So because they've taken lesser duration papers in that, so there is no exit load in liquid funds. That's the only difference between accrual and liquid. If I come to income/dynamic category, these are funds with more than about 70-75% exposure into Government of India securities. Now, this exposure of about 70-75% into Government of India securities make these funds very volatile. A lot of people will question that G-Secs are the most safest instruments in the market because they are issued by Government of India. How does that make this fund more volatile? Well, the answer to that is Government of India securities, how these income funds and dynamic funds play with them is, let's say today I have a Government of India securities which gives me about 7.5%, for example, and the rate which I get it in the market is, let's say, 100 rupees per bond. I'm just taking a hypothetical example. Let's say tomorrow there is a rate cut and the rate of these securities come down to 7%, for example. So I have a security which is giving me 7.5%. The best available in the market is at 7%. So I will sell my security at a premium. So let's say if they are available for 100 rupees in the market, I'll not sell it at 100 rupees. I have a security which is giving me a higher return than the market. So probably I'll sell it at 120 rupees, 130 rupees, whatever premium I can get from them. So it's not just the accrual return, that the rate of return that these government of securities give, but also because of the interest rate cut or interest rate increase in the market, the price differential that I get. Now, what makes them more volatile? Let's say if instead of a rate cut, a rate hike happens. The best possible available securities in the market is, let's say, giving me 8% now. So I have a bond which is giving me 7.5%, whereas the market is giving 8% on the same bonds. I can't sell it at a premium. In fact, I can't sell it at the same price. I'll have to sell it at a discount. So instead of 100 rupees, I have to sell it at probably an 80 rupee or a 90 rupee. So I can incur a loss in that. Right. So, it's very sensitive to the rate hikes and the rate cuts in the market. if there is no rate hike, no rate cut, then you end up getting what, 7.5% on these securities. Hence, these income and dynamic funds, because of its dynamic nature and because of this volatile nature, are recommended for people who can, withstand that volatility and can, for a horizon of, let's say, 3 to 4 years, 3 to 5 years, not before that, because there is a lot of volatility which is involved in this. Accrual in liquid funds can be for people for investing for 1 year also, for 3 years also, for 5 years also. That's up to them. For liquid, you can also invest for 6 months, 3 months kind of a time also, for 1 month. Some people also do a weekly kind of a parking in that. So let's say they put their money on Friday, take it out on a Monday or a Tuesday, accrue a return of about 2-3 days every week. In a particular year, there are about 52 weeks, so I'm getting a return of about 9.5% in liquid per annum. So if I calculate for a 150-160 days in a year, if I put it on Friday and take it out on a Monday, I end up getting about 4.5% on an absolute basis. So liquid funds can be for very short period also. Accrual should be about 1.5 years. Income dynamic will recommend for about 3 odd years. That's in a nutshell of the type of mutual funds that we have. We'll come back with some taxations and some other things in these funds in our coming video. Thank you again for watching us. Thank you for subscribing to our channel. Again, please leave your valuable comments in the comment section below. Thanks. See you next time. Bye bye. Take care.